Hey, real quick before we get into this. Have you ever walked into a grocery store, grabbed your usual stuff, and thought, wait, did everything just get more expensive overnight? Like the same bag of chips you've been buying for years suddenly costs $4 more and nobody told you why. Or maybe you've heard someone on the news say, the Fed raised interest rates again, and you just kind of nodded along like you totally understood what that meant. But inside you were like, what does that even have to do with my life? Well, today we are breaking all of that down. We're talking about interest rates, inflation, and the wild and honestly kind of genius system that's been quietly controlling the price of literally everything you buy. And I promise you, by the end of this video, you're going to understand it better than most adults do. Like, embarrassingly better. We're going to cover what inflation actually is, how interest rates work, why the government raises and lowers them, and what it means for your wallet. We're also going to bust a pretty common myth about how this whole thing works, because most people get it completely backwards. Stay with me. This one is going to click in a way you did not expect. Okay, so let's start super simple, like really simple. Imagine you're a kid. You've got $5, and at your school's snack stand, $5 gets you a slice of pizza and a juice box. Life is good. You are thriving. Now imagine next year, you still have your $5, but now the pizza slice costs $3.50, and the juice box costs $2. You are now 50 cents short. Your $5 just doesn't go as far anymore. Why does this happen? It comes down to supply and demand. Imagine there's a really popular sneaker. Only 100 pairs exist, but 500 people want them. What happens? The price goes up. The seller knows people will pay more because there aren't enough pairs to go around. Now apply that same idea to the entire economy. Imagine everyone suddenly has more money in their pocket. Maybe the government sent out stimulus checks. Maybe borrowing money got really cheap. Now you've got a lot of money chasing the same amount of stuff. And what do sellers do? They raise prices, because they can. Now, a little bit of inflation is actually totally normal. Most economists actually want about 2% inflation per year. That's slow enough it doesn't hurt too bad. The problem is when it gets out of control, 10, 15, 20% in a year. Now your paycheck buys way less. That's when it becomes a crisis. Hey, quick pause. If you're the kind of person who likes understanding how things actually work, not just the surface stuff, but the real mechanics behind everyday life, then you are in exactly the right place. Hit that subscribe button right now. It's free, 2 seconds, and you'll never miss one of these. Smash that like button too. Okay, back to the good stuff. Now let's talk about interest rates. An interest rate is the cost of borrowing money. Let's say you want to borrow $100 from your friend. Your friend says, sure, but you have to pay me back $110 next month. That extra $10, that's the interest. It's basically the fee for using someone else's money. If the interest rate is low, borrowing money is cheap. It barely costs anything extra. So what do people do? They borrow more. They take out loans. They spend more money. Businesses borrow to expand, hire people, build things. The whole economy gets a rush of energy. But if the interest rate is high, borrowing money becomes expensive. That extra fee is painful. So people think twice. They borrow less. They spend less. The economy slows down a bit. Who decides what the interest rate is? In the United States, there's this group called the Federal Reserve. People call it the Fed. It's basically America's central bank. One of its most important jobs is setting the federal funds rate, which is the baseline interest rate that influences everything else. When the Fed changes that rate, even a tiny bit, it ripples across the entire economy. The Fed is basically the DJ of the economy. When they turn a knob, the whole room feels it. Inflation is out of control. Prices are spiking. People are stressed. The Fed looks at the situation and goes, okay, time to raise interest rates. But why does raising rates help? What's the actual chain reaction? Step 1. The Fed raises interest rates. Step 2. borrowing money gets more expensive for everyone. Banks pass that cost on to you. Step 3. People start borrowing less. That car loan that felt totally doable at 3%, now it's at 7%. So maybe you hold off on buying that car. Step 4. Businesses borrow less too. That restaurant planning 3 new locations? The loan's too expensive now. Maybe they only open 1. Step 5. Less borrowing means less spending. Step 6. When demand drops, sellers can't raise prices as easily. Step 7. Inflation cools down. Your $5 buys a little more again.
Here's the myth I mentioned at the beginning, the thing most people get completely backwards.
A lot of people think the Fed raises rates to directly lower prices, like they flip a switch and boom, stuff gets cheaper. But that's not how it works. The Fed doesn't control prices directly. They control the flow of money. It's less like flipping a light switch and more like turning down the heat on a stove. There's a lag. Rate hikes don't instantly fix inflation. Sometimes it takes 6 months to a year before the full effect shows up, which makes the Fed's job incredibly hard because they're always acting on information that's a little bit old. Imagine driving a car, but your windshield only shows you what was behind you 30 seconds ago. That's the Fed. But what about the flip side? What happens when the economy isn't overheating, when it's going the other direction? When people are losing jobs, businesses are closing, and nobody's spending money. That's called a recession, and it's the opposite problem from inflation. So what does the Fed do? They lower interest rates. Borrowing money becomes cheap again. People go, "Oh, I can finally afford that car loan, that mortgage." They start borrowing, they start spending. Businesses hire more people. More people have money. The economy picks back up. It's like giving the economy a cup of coffee when it's falling asleep. Here's the tricky balance. If the Fed overstimulates by keeping rates too low for too long, inflation kicks back in. If they raise rates too aggressively, you get a recession. It's a constant balancing act. Too much gas and you crash. Too much brake and you stall. They're always trying to find that Goldilocks zone. Not too hot, not too cold.
And they don't always get it right. The 2008 financial crisis?
Rates had been kept really low for a long time, which helped create a massive borrowing bubble. When it popped, it wrecked the global economy. The 2022 inflation spike? After years of low rates and massive pandemic spending, inflation hit 9%, the highest in 40 years. The Fed had to raise rates fast and hard. What does all of this actually mean for you? First, your mortgage or rent. When interest rates are high, mortgage rates go up. More of your monthly payment goes to interest rather than actually paying off the house. This is why a lot of people can't afford to buy homes when rates spike. Your credit cards. Most credit cards have variable interest rates, meaning they go up and down with the broader rate environment. When the Fed raises rates, your credit card interest rate often rises too. If you're carrying a balance, you're paying more in interest charges. Kind of quietly painful. Here's the silver lining. When rates go up, savings accounts actually pay you more interest. If you've got money sitting in the bank, high rates work in your favor. Your money grows a little faster, and your job. When rates are high and the economy slows, companies often start laying people off or freezing hiring. When rates are low and the economy is booming, jobs are easier to find and wages tend to go up. So yes, a small group of people in Washington, D.C. indirectly affect whether you have a job. So basically, interest rate decisions made by a small group of people ripple out and touch almost every single financial decision in your life. Most people have no idea this is even happening, but now you know. And honestly, that's kind of a superpower. Let's zoom out. Why do we even have this system? Before central banks existed, economies were incredibly unstable. You'd have wild booms followed by brutal crashes where banks just collapsed. People would wake up and find their life savings gone. Back in the 1800s, the US had financial panics roughly every 10 to 20 years. Devastating. The Federal Reserve was actually created in 1913, specifically because of a massive financial panic in 1907. People looked at the wreckage and said, okay, we need something to stabilize this. We need a referee with tools to step in when things go sideways. Is it a perfect system? Absolutely not. Smart economists argue constantly about whether the Fed acts too slowly, too quickly, too boldly, or too timidly. There are legitimate debates about whether central banks have too much power. But the basic principle, using interest rates to control inflation and stimulate growth, has become the foundation of pretty much every modern economy on Earth. Okay, let's bring it all together one more time, nice and clean. Inflation equals prices go up, money buys less. Interest rates equals the cost of borrowing money. Fed raises rates, leads to borrowing slows, leads to spending slows, leads to inflation cools. Fed lowers rates, leads to borrowing rises, leads to spending rises, leads to economy recovers. And all of this touches your mortgage, your credit cards, your savings, and your job. It's not magic. It's not complicated. It's just a big, interconnected machine, and now you know how it runs. Most people never take the time to understand this, and you just did it in like 15 minutes. So, you're doing great. If this video made something click for you, drop a comment below. Tell me what surprised you most. Share this with someone who nods along at the news but secretly has no idea what's going on. Like the video, it helps more people find it. And subscribe. We break down how things actually work regularly in a way that actually makes sense. I'll see you in the next one.